Hey traders, Barry Burns here with Top Dog Trading, and today we're going to talk about in option trading, the missing Greek. Sounds very dramatic, very curiosity-provoking, but it is very important. And I rarely hear option traders talk about this. So let's jump right into it and reveal the missing Greek and why it's so important. This really is critical to your option trading. So in the last video, by the way, this is a little series on option trading. I'll put the links down in the description below for the other videos if you want to follow the whole series along. And we talked a little bit about Theta. That is time decay. If you are buying options, basically you want to buy them 90 days out away from expiration because time decay has a parabolic move and decays faster as we get closer to that expiration. If you're selling, then usually we sell less than 30 days out from expiration to put Theta on our side. Delta, now Delta and Gamma, we're going to talk about these. I'm not going to emphasize them too much. We talked about them in the last video, though, when we talked about buying options. So Delta is simply the speed at which the option price, remember this, the option price, is expected to move for every dollar move in the stock. So as we talked about in the last video, if you want to buy options, we have a problem, and that problem is to overcome the cost of buying the option before we break even on the stock. If you buy a stock, you're at break even right away. If you buy the option on the stock, you are not, because you've got the premium, and you got to overcome the cost of that premium before you break even on the stock. So if you're going to buy options, you got to have options that really move, especially if you hold to expiration. So delta is very important if you're a buyer. All right, but remember, and I'm setting up for where we're going here with the missing option, it's the speed at which the option price is expected to move for what? Every $1 move in the stock. Now, gamma, then, is, whoops, went a little too fast there, the acceleration of the options price. So it's the rate at which the delta will change based on a dollar change in the stock price. So again, we're talking about these option prices in relation to how fast they will move to the stock price. Now, if you remember in the last video, I talked about how many option traders neglect really learning to read the underlying or the chart of the underlying market, because options are derivatives. They're derivatives of the stock or commodity or forex market, whatever you're trading them on. And so you really need to begin with understanding the underlying market before you make your choice about options, the Greeks, the strategies, all that kind of stuff. Those come later. But if you don't understand the stock you're trading, its dynamic, the money flow, the energy, the chart pattern, what you expect it to do, then really options is just a fool's errand. It's really sad. And then Vega, we haven't talked about Vega yet. We'll do another video on that. That references volatility, often commonly misunderstood. So today, though, we're going to talk what is this missing Greek. Actually, there's two missing Greeks. So one is talked about a little more, that is rho. So most people have heard of rho, but they don't really use it in their option trading. So I'll do another video on rho as well, because if you don't use rho, that can really destroy your option trading account. And again, most people dismiss it like it's not important. Yeah, that's a big mistake. So we'll dedicate another video to that. Today, the missing Greek I want to talk about is beta. So if you've been really listening to what I've been saying, you're going to understand how important this really is, and yet rarely talked about in option trading. So beta is the change, or I'm sorry, the rate of change in a stock price, not the option price. Right? Delta and gamma, those were the change in the option price. But now beta is the rate of change in the stock price relative to a benchmark, usually the S&P 500. So especially if you're trading equities. So now why is this important? Again, because delta and gamma are changes in the option price relative to the change in the stock price. So we better have some sort of feel, some idea of what that stock price is going to be. And if you want to buy options, you want that stock to really take off. And then the option prices are more likely to expand as well, all things considered. Put this all together, right? It's like a little puzzle. Each one is a piece. Put them all together, and you're golden. You miss one, and you're not going to have a pretty picture. And your trading account is not going to look pretty at the end of the month. So this is where it actually begins. This actually, my friends, is the foundation of option trading. And of course, now if you're selling options and you're trading some sort of option strategy where you really don't want the market to move, this is still very important because then you want a low beta. So beta is defined 1.0 means that if the S&P moves up, say 0.5%, then the stock should move up 0.5%. That makes sense. One, even, right? They're moving in concert with each other. A beta of 2.0 would mean that if the S&P moves up 0.5%, then the stock should move up 1.0%. In other words, twice as much. The rate of change should be twice as much. Would be great for option buyers. If you're buying a stock, what kind of stock do you want? Do you want one that has a beta of 1.0? Or would you rather have one that has a beta of 2.0? I think you know the answer. Now, let's take a quick look over at we'll look at Thinkorswim. Let me show you how you can analyze this, look at it, and make some decisions. Hold on one second as I bring up my Thinkorswim platform. All right, so now you should be able to see a watch list here, and this is simply of the S&P 500 I brought up. And we'll move this over a little bit so you can see the symbols better. Okay, and so we've got our columns here, and you can set up different columns. And by the way, different charting platforms, obviously the functionality is going to be a little different. I'm sorry, I'm not familiar with all the charting platforms, so I can't help you with that. But I'll show you how to do it in Thinkorswim. And then if you use a different charting platform, just contact your software provider and ask them how to do it in theirs. They know theirs better than I do because, well, they made it, and they do have a support team for you. All right, so what we're going to do is click on this little gear here. See the little gear? And I guess it went off the side there, but it's called Customize. And then what you do is you can customize your rows, or I'm sorry, your columns. So we're just going to go down here, and we are going to choose Beta. Now, they have Beta 2. I like to use Beta, just the regular Beta. Add items. So here's your current set of columns. And click over there, and bada bing, bada boom, there we go. So now we've got a column for beta. All right, remember, we know what our numbers are, right? We understand that 1.0 means that the stock is basically moving the same as the S&P 500. Above that is more. So we can sort by this, and let's put the biggest numbers at the top. So let's say that you're not necessarily going to bring up the S&P 500, but let's say that you've done some work and you've created a watch list, a number of candidates that you feel are good trades based on whatever your criteria are. All right, so you bring them up into this, and you can start by saying, well, golly, I've got maybe, 20, 30, 50 candidates. How do I choose which one I want to trade? Because I don't have a big enough trading account to take option positions on all of them. And so you can, this is one part of the puzzle again. You can sort by beta, and you can look over here and say, oh, wow, that one's got a beta of almost 3, 2.6, and go right down the list. All right, and so this would be one way to sort out some of the candidates, to narrow it down to which ones will be the best. And again, that's pretty much it. That's just one criteria. It's that simple. Again, you would not do this alone and only trade based on this, obviously, but it's one other piece of evidence. So we're looking for a preponderance of the evidence of the best candidates. And if you're buying options and you want something to really take off, then this would be another piece of evidence that you could use along with others that you use and add it to your criteria. And I think it would be a very, very helpful one for you. So try it out, test it, see how you like it. I find it to be very, very powerful. And again, most people aren't doing this. And that's why they wonder, how come my options didn't move? What's going on? Or why did my option all of a sudden take off and I'm selling it and I don't want it to move? and this would be one criteria as to why. So, hey, I've got a gift for you, as always. People who watch my free YouTube videos, I also give you my free trade strategy called the rubber band trade, and I'd love to share that with you, get you making some money right away. I'll put the link in the description below, and also we'll put a little icon there at the top right corner of the video, which hopefully you should be able to click on that, and that'll take you to the page where you can tell us which market you trade. And we'll give you the rubber band trade strategy absolutely free. I still take this trade to this day. I've been trading this thing for over 10 years. It's just so darn consistent. And what I love about it, it has a super high win-loss ratio. And it's a fast winner. A little scalp trade, but fast winners and lots of winners, and get those under your belt. I don't charge for it. It's my gift to you to prove myself to you, and you can decide then if you want to work with me or not. But either way, try it on a simulator, a demo account, and let the trade prove itself to you.